Welcome to our GraySwan market overview. I'm Gregoire Theron. Let's just kick off with what happened in 2022. And I think the key message here is that 2022 was one of the hardest periods for most asset classes. If you look on the left-hand side, on the x-axis, you're seeing bonds. So global bonds down in dollar terms in excess of 15%. And if you're looking at global stocks, as per the MSCI World, down almost 20% for 2022. And if you look at the blue dots you can see on the right-hand side here, historically, you haven't had a period where bonds and global equity sold off that much during the same period. And it just shows you the big interest rate increases we experienced during 2022, an inflation environment which caused global bonds to sell off as well. So 2022, a very, very hard period for most asset classes. But I think the key is let's look forward. Let's look at where markets are currently. Let's look at what markets are pricing in currently. And where do we see the risks and where do we see the opportunities for 2023? So 2023, starting off with a bang. Global equities, and this is all in Rand terms. If you're looking at global equities, as per the MSCI World, up 13.92%. And this is up to the 14th of February. If you're looking at global property, up 14.04%. Emerging markets, which is that basket of China, India, Brazil, South Africa also included in their small component, up 11.76%. JSE, if you look at the top 40, 10.28%. Most asset classes up very strongly. Even South African government bonds up 2.82%, and the Rand weakened by 5.14% during this period. So a very strong period for asset classes, and a bit strange if you're looking at this, because typically during these strong rally in asset classes, you see a stronger Rand, which actually hasn't been the case, but I'll get to that. In terms of what has driven equity markets up so strongly in this first component or part of 2023, and it's really this one slide. It's all about what the markets are pricing in terms of what the Fed is going to do, meaning what the Central Bank of the United States are going to do during 2023 with interest rates. And typically other markets follows what the Fed does. So important to look at what they're going to do. And the key is to look at the triangle, the gold triangle. This is what the Fed's telling the market, the Fed median dot plots. And that indicates on where the Fed thinks interest rates are going to be over the next year or so. So you can see the big dispersion or difference between what the market are pricing in, and that's what these lines are, and what the Fed's telling the markets are massive. So what's happened during this first part of 2023? The markets do not believe at what the Fed's telling them, and the markets are pricing in that the Fed's going to start cutting interest rates much quicker than what the Fed's telling them. And that's caused this massive rally in global equity markets. That's the big component. Another component is also that the Chinese economy started opening up in 2023, and that's also caused emerging markets and cyclical stocks and resources to start rallying as the US economy starts or Chinese economy starts opening up. But this slide is the key in terms of what's happened in global markets for the start of this year. Now, you've got to look back at data and ask yourself, from our view, what is the Fed going to do with interest rates? And do we think the markets are too optimistic in terms of what they think, what the market thinks is going to happen with interest rates through this next cycle? So the first thing you need to look at is US unemployment rate. And this is important because it indicates the strength of the US economy. And if you look at where the unemployment rate of the US at this point in time is Jan 2023, the last time we saw such low unemployment numbers was back in 1969. So what does it tell us? It tells us that the US economy is very strong. Most people have a job. And that means that the Fed can potentially keep interest rates higher for longer, or even keep hiking interest rates because the economy is strong. And that's quite critical. What's the Fed worried about, and what do we look at? One of the things you need to look at is wage growth, and this slide just shows you the wage growth, meaning the change in the hourly rate of employment in the US. And currently wage growth is in the region of 6%. So you have very high wage growth in the US, and this is also causing some inflation. It's something the Fed's worrying about, because if you have very high wage growth, that could be inflationary, come through in the inflation numbers. So look at this data, very important. Also, why is this important? Because operating margin or earnings of companies, one of the big inputs there are the cost of wages. And we're seeing this wage growth being quite sticky in the US, and this could have a negative impact on margins or earnings of companies as we go through the next cycle. So very important to look at that. In terms of inflation, the Fed is looking at core CPI, meaning inflation less food and energy prices. And we are past the peak of inflation. We do believe that, but the question is not really whether we passed the peak of inflation. The more important question you have to ask yourself is, how high is inflation going to stay, and how quickly will inflation come down? Because that will impact the path of the Fed during this next interest rate cycle. And you can see inflation is still very high at this point in time. So again, thinking that the Fed's going to start cutting interest rates very quickly may be a bit optimistic at this point in time. Also importantly, on this slide, look at the gray shaded areas. And if you're looking at the gray shaded areas, those are historical recessions. And we have seen historically that if inflation comes up very strongly, like we've seen historically, it does cause or lead up to a recession. It's typically because the Fed starts hiking interest rates to keep inflation at bay. We are not in a recession at this point in time, but the markets are worried about a potential US recession. This is a very interesting research piece by research affiliates. And one of the questions we have to ask ourselves is that in this environment where inflation has peaked up dramatically across the globe, how easy is it to get inflation back to levels which central banks are comfortable with? Now, this is a study by research affiliates. They've got back more than 60 years. And the aim of the research was just to say that if US inflation breaches 4%, how easy is it for inflation to come back to 3%? And the answer is quite easy. It happens quite quickly. It becomes harder if US inflation breaches 6%, then it becomes hard to bring inflation back down to below 3%. And if inflation breaches 8%, then it becomes very hard to bring inflation back down below 3%. And with hard, I'm talking about the time it takes to bring inflation back down to below 3%. History tells us that when US inflation breached 8%, it's taken between 6 and 20 years for US inflation to come down below 3%. And on average, it's taken 10 years to come down below 3%. Why is the 3% important? The Fed's targeting 2% from an inflation perspective. 3% is quite close to that, and it's within that range that the Fed's looking at. But the bottom line behind this research is that since 1977, it's not been easy to get inflation down below 3% that quickly. And the market's not pricing this in currently. And this is why we've seen that dispersion between what the Fed's telling us in terms of the dot plots and where the market's pricing interest rates. So that's caused markets to rally. How has markets performed historically during bear markets? Well, currently, if you look at the dark line here, this is the current bear market on the S&P we're seeing. And historically, looking back from 1926, during various periods, you can see that markets falls for a longer period of time, specifically during recessionary periods. So this current bear market is not very long in the tooth. And it could go on for a substantial time further from here on in. On average, it takes in excess of 20 months to reach the bottom of a bear market. The next slide shows you, and again, it looks at recessions, US recessions. It looks at the labor market, and it looks at the bottom of the S&P, the US stock market. And what's the aim of this slide? The aim of the slide is to try and look for bottoms in the S&P 500 historically, going back to the 1960s, and what are certain of the data points you need to look at, or which are the things that needs to happen to typically see the bottom of an equity market. And here we're looking at two things. Firstly, you're looking at recessions, meaning that is the gray shaded area. The green line indicates the bottom of the equity market during this bear market. So it shows you the bottom of the equity market at this black vertical line you're seeing down. And the purple line shows you US unemployment. And there's a couple of takeaways from these slides. During all these periods, you've seen that the US typically has to go into a recession first to see the bottom of the equity market. Important point from that. Secondly, is that you need to look at unemployment rate. The unemployment rate of the US, historically, unemployment has to start going up. And we're not at that point in time. I've just spoken about US unemployment still at 3.4%, back at levels we've last seen in 1969. We are starting to see companies cutting back on unemployment. It's not in the numbers yet, but from forward guidance from the last US earnings seasons, we're starting to see corporates cutting back on staff. And I think that's what we need to start seeing as well, to see the bottom of the equity market. So none of these things has really started to happen yet. In terms of US recessions, I've spoken about US recessions, and historically, you sort of need to look for US recessions, and during those periods or after that period, you see the bottom of the equity markets. Are we in a recession at the moment? No, the US is not in a recession at the moment. But there is a leading indicator that's been quite good at predicting US recessions historically back, and that is the yield inversion. So if you look at the 10-year US government bond minus the 2-year government bond, and when that inverts in terms of that yield, we've seen a recession a couple of months after that inversion of the yield. And what we're seeing at the moment is that the yield inversion, this US recession indicator, is currently already inverted, and it's currently at one of the deepest inversions we've seen in more than 40 years. So again, more than 30 years. And again, it's just an indicator to tell you, just be wary of where markets are at the moment, because we have signs that we are potentially going into a US recession. This slide just shows you historically when the yield curve inverted, how long did it take from that first point inversion for the US market to actually go into a recession. On average, it's taken 24 months. And we are not close to even 24 months at this point in time. So again, we've just had the yield curve inversion. So again, I think there's some time to play out, potentially to see the bottom of the equity markets. Why is markets optimistic again in 2023? Because they're looking forward. Markets are looking forward at where the Fed's potentially going to go with interest rates, looking for a potential cut in interest rates, or tilt, which the markets are calling. Now, again, if you test this back historically, that historically a tilt by the Fed, meaning a interest rate cutting cycle by the Fed, has actually not been good for global equity markets. It's typically been a period where there's a recession, or where there's some financial crisis, where the Federal Reserve starts cutting interest rates. And this graph just shows you on the x-axis, it's the days from the first cut when the Fed starts cutting interest rates to the low in the S&P, so the low in the US stock market. And it takes, on average, 195 days since the Fed starts cutting interest rates. And on average, that drawdown, meaning from the point in time where the Fed starts cutting interest rates, how far does the equity markets or the US equity market go down? Well, it's 23.5%. So again, be careful what you're wishing for here, because historically looking back, the Fed has not been great for equity markets. I've spoken about earnings and potentially the risk of high wage growth and the impact on earnings or operating margins of companies. And simplistically, what is the operating margin of a company? Well, it's the amount of dollars a company makes on their sales after variable costs such as wages and materials. And that's important because I've spoken about wages. You see wage inflation at 6% in the US. This is a big bottom line which are coming through to companies, which are impacting operating margin of companies. On the right-hand side, what we're seeing is is just since 1993, if you look at the average S&P 500 operating margin of companies, it's been just above 8. Currently, the market's well above that 8 long-term average. And again, over time, a lot of these numbers mean revert. So again, we think there's a risk that earnings are potentially too high at this point in time, as some of these inflationary pressure starts creeping in, as wage inflation starts creeping in. You could see earnings of companies starting to come down, and we've already started to see that the forecast for big companies in the US are more on the negative side. So we're potentially starting to see this pressure on earnings coming through. How's the markets placed at the moment? Because if there's a lot of negative news in the markets, negative news potentially on earnings, risks in terms of yield curve inversions, and risks of recessions, and the markets are priced very cheaply, then it means the markets has priced a lot of these risks into global asset classes. And it's not what we're seeing at the moment. At the moment, if you're looking at the Fear and Greed Index, it's an index that looks at breadth of the market. It looks at various moving averages. It looks at bond spreads. And what we're seeing is that the markets are currently in greed despite a lot of these risks. And it comes back to that one of those previous slides I showed you where the markets are not believing the Fed and thinking that the Fed's going to start cutting interest rates quicker. So the markets are in a point of greed at the moment. And typically, historically back, these are points in time where you need to start cutting back or putting some risk metrics into your portfolio to protect your portfolios. If you look at the US equity markets, again, looking at where valuations are at the moment, and the middle green dotted line shows you the 25-year average of the S&P from a price to earnings perspective, and that average is 16.82. Currently, the PE ratio of the S&P is close to 18%. 18. So 18 is not cheap currently, and remember how the PE ratio works. It's the price over earnings. So if equity markets, the price of equity markets stays the same where it currently is, and we start having this compression or the pressure on US corporate earnings and earnings starting to come down, that means the PE ratio will start going up and markets would actually look even more expensive because of lower earnings. And that's one of the risks we see in the markets. It may not look that expensive at the moment, but it's a function of where earnings of companies is. And if we start seeing the pressure on earnings of companies, then potentially we could see further pressure on global equity markets. A lot of the risks in the markets, equity markets priced above long-term averages, specifically the US. I can tell you that countries such as South Africa and various emerging markets are trading quite cheaply at the moment. So there are opportunities within global markets. You need to look for it, and you need to tilt into these opportunities. This is another opportunities. I think what has drastically changed over the last couple of years has just been that if you go back to pre-COVID or even the COVID periods where bond yields were close to zero, if you look at the US, so basically you got nothing investing in bonds or cash rates. Suddenly we're in an environment where you do get yield, or meaning you do get income investing into cash or bond assets or income assets. And this slide shows you, if you look at the yellow line at the top here, it shows you the South African 10-year government bond, which are currently yielding at 10.1. So you can get a yield, an income of 10.1% currently. And that's above inflation plus 3 currently, where South African inflation is close to 4. But if inflation goes back to where the Reserve Bank's targeting inflation, the 4.5% range or 4.5% midpoint, then your yield of 10.1% is very lucrative. If you're worried about Eskom debt and you're worried about various debt levels of the South African government, then you can also buy shorter dated bonds. And the 2-year South African bond is yielding you 7.5%. Again, a very lucrative return in this environment currently. So it's not just investing into equities. There are other asset classes to look at. Even in global markets, from a South African perspective, to diversify your portfolio as well, you can invest into a US 10-year government bond, which are yielding 3.8% currently. And that should give you protection if we go into US recession and the Fed starts cutting interest rates. That asset class should give you a lot of protection and a good diversifier in your portfolio. but also cash. So shorter duration bonds, so that the US 2-year government bonds yielding you 4.6% at the moment. Over the long term, if you think that the South African rand has depreciated by close to 7% against the dollar, and if you keep having the structural depreciation of the rand against the dollar, and you could get yields in this range, then a 4.6 return in dollar becomes very lucrative. So there's a lot of opportunities out there at the moment. It's not just in income assets. We've had this big rally in 2013 where growth assets rallied quite dramatically. So for us, it's a point in time where you should start looking to cut a bit, take some profits on those growth assets, go into some income, but also put some protection on your portfolios. So most of us insure our homes, we insure our cars. Why not insure your investment portfolios? And you can do that. You can use derivatives and various strategies to buy protection on your specifically equity market portfolios. And it's very dependent. The cost of insurance is dependent on volatility. And currently what we're seeing is that the VIX, which indicates volatility in equity markets, are at low levels. So it means that the cost of insuring your equity market portfolio is not that expensive currently, and it's worth, after having this massive rally we've just experienced at the beginning of 2023, to start putting some protection in place. So there's also opportunity to put some protection in place. If market falls, you can unwind this protection and buy into equity markets at lower levels. So a lot of risks for 2023, but over the long term, investing is still a long-term investment strategy. And if you're looking at asset class, long-term expected returns for asset classes, then we still think there's a lot of opportunities. This is a slide by M&G, and what they do is they model what the expectation is for asset classes above inflation. So the green are South African assets, and the zero line is inflation. So as an example, this slide shows you that currently where bond yields are trading and where the value of yields are, especially shorter duration bonds, you could expect almost a return of 3% above South African inflation through the next cycle. Inflation-linked bonds, just next to that, given where the yields currently are, 4.4% above South African inflation. South African government bonds almost 6% above inflation. Now, that's a very lucrative return if you think that over the long term, South African equities should produce just in excess of inflation plus 6. And here you can get that through buying South African government bonds at, we believe, much lower risk. So a lot of opportunities out there. South African equity markets still trading very cheaply. As I mentioned, it's not just South African equity markets that's trading cheaply. It's also other emerging markets such as China, Taiwan, and so forth, which are also cheap at this point in time. So you need to look to allocate into these asset classes. On the right-hand side, it shows you global equities, world equities, relative to global inflation. So the expectation through the next cycle is 6.7 above global inflation. And even government bonds, if you look back a year ago, negative real return, where it's changed now. Suddenly, looking through the cycle, you can achieve 1.2% above global inflation holding government bonds. So a lot of opportunities we see in this environment for the long term. So it's not an environment where you just sit in cash. It's an environment where you have to have a balance of asset classes in various assets where there's opportunities, but look to take some profits during points in time where markets rally strongly. So in terms of positioning, just to finalize, looking at the macro outlook, we do believe there's a lot of risks out there. You have the recession risk, we have earnings risk, there's geopolitical risks at the moment, but we've seen markets rallying massively during 2023. So from our perspective, after this massive rally, we do think that it's a point in time where you should take a bit of profits on your equities, your growth assets, and also on your bonds. Why is that? Because the latest producer inflation print out of the US surprised on the upside, and again, it's just the sign that inflation is not quite under control, and it just could cause interest rates to stay higher for longer. So therefore, take some profits on your equities and on your bonds. You've just made a big return. and you can get proper income on yields and wait for opportunity to buy into asset classes or growth assets, specifically when it's a bit cheaper. Market volatility has come down dramatically from where we were in 2020 during COVID. And currently, it makes sense to buy protection on portfolios. You can buy various protection strategies on the JSE currently, where you could get almost 19% upside cap on your equity exposures and 10% downside protection at zero cost. So these type of strategies make sense at the moment. Further on, our view is still to maintain large offshore exposures. The South African market's very concentrated. If you look at the makeup of the South African market, big component to resources, which we're happy with, but then you also have big exposure to the likes of Naspers, Prosus, and Richmond. And those exposures are very as high, as high exposure to China and the Chinese economy. So it's important to diversify your risk away from single stocks as well. So from our perspective, we would like to maintain large offshore exposures. It diversifies your risk away from South Africa, away from Eskom, away from South African debt, potential debt problems, away from South African political problems. But what you could do is you could hedge out the currencies. So at this point in time, with the range trading at roughly 1805, and we may see some more pressure running up to the budget this week, there's opportunities to actually put some currency hedges in place and protect yourself if the rand strengthens, if there's some positive news. So that's one way of managing your portfolios and having some diversification. As I mentioned, there's a lot of concentration risk in the South African equity market, and a lot of that exposure is dependent on the Chinese economy. So therefore, from our view, it makes sense to actually cut back on your SA equity market exposures, take some assets abroad and invest into other emerging markets, just to diversify your portfolios. Just like South Africa, other emerging markets are trading at very cheap valuations. So it's a good diversifier in a portfolio. When you can manage the currency risk, as per the previous point, using currency hedges. Second last point there, given all the risks in the market, it's about having a balanced approach to asset allocations. Whereas historically, back over the last 10 years, it's been a period of TINA, meaning there is no alternative, and equities has really been the only place to invest your money. That period has changed. Suddenly there are opportunities in other asset classes. Global listed property, we believe, are trading quite cheaply, and I think there's opportunities there. Diversifies you away from the South African market. You get income on global assets in dollar terms. You get income on local assets. Gold is a great diversifier in a portfolio. Commodities at this point in time, with the whole shift away from renewables, which are happening quicker than I think most people anticipated. And that means there would be a big drive towards commodities, copper, for instance. And that could be very supportive for commodity prices through the next cycle. So again, diversify your portfolio in this environment. Another key point with commodities also is that it is dependent on where the dollar is going. The dollar has been extremely strong due to these interest rate differentials between US government bond yields and what European bond yields are. But potentially we're at the end of the cycle, and you could see a period where the dollar starts weakening. And in that environment, commodities typically does well as emerging markets, also gold. So look for asset classes that also gives you diversification should we have a weaker dollar environment. And then the last point there is just active asset allocations. Again, we've been in an environment where bond yields were very low, where equities were almost the only place to invest in. With bond yields much higher, and if bond yield stays much higher for longer, it could mean that this fight between income assets and equities stays there for longer. That means you're going to have a much higher volatility in global equity markets, and therein lies opportunities. Because you could see markets going down 10% quite quickly. If you're holding cash, you could buy into the markets at lower valuations, take some profits and move in again. And so you should look for portfolios which could give you some asset allocation alpha during this environment. So that's it for me for 2023. Great start to the year. Market started off very optimistic, and I'm grateful portfolios, grateful pensioners, just great for your assets. But again, at this point in time, from our view, we think there's a lot of risks lying ahead. It's about taking some profits and putting some protection in place in your portfolios and look for opportunities during this year to make some money for our clients. So that's it from our side. Hope you have a wonderful day. Thank you. Bye-bye.